So it's been 5 years since the financial crisis. What progress have we made? We've passed all these huge laws and written all these huge regulations. But when you look at simple big picture things, it's astounding how little has changed. European banks still treat sovereign debt as risk-free. Money market mutual funds, there was a run on them. Banks still are issuing very little capital. We're sort of fighting desperately over raising capital requirements a few percentage points. So the political and regulatory front strikes me as ripe for the next crisis. The academic intellectual front, I think we've made a lot of progress understanding how these things work. So if anybody would like to listen to us, I think we know how to craft a much better system of financial regulation that would actually work.
In September 2008, the financial crisis began in earnest with the collapse of Lehman Brothers, one of the US's biggest investment banks. Nearly 5 years on, thousands of pages of legislation have been passed to reform financial regulation, yet the global financial system still needs fixing. If we are to address the issue, we first need to understand what happened. What caused the financial crisis? Faculty at the University of Chicago's Booth School of Business have been working on that question for many years. One of their central insights is that the crisis was caused by the same phenomenon that causes every financial crisis: a run. Douglas Diamond has been researching the question of financial runs for decades.
Whenever I give a talk, I like to say financial crises are everywhere and always about the problems of short-term debt and the reasons we use short-term debt. And what that means is that financial crises are really about runs where people rush to get their money very quickly, and it brings down a financial system. So financial crises are caused by anything that makes people want to run. It could be losses, it could just be panic. Some work I did 30-some years ago with Phil Divig from Washington University tried to come up with a very simple framework that said, effectively, what the banking system does is finance fairly long-term assets that aren't perfectly liquid, can't be sold for full value, with short-term deposits. That helps depositors and makes money for the banks and works very well as long as all the depositors don't ask for their money at the same time. But if all the depositors think the others are going to ask money for their money at the same time, it's the end of the financial system.
John Cochrane emphasizes that the insight about runs being at the heart of financial crises is critical when it comes to proposing fixes.
Financial crises are about runs. And I think that's the deep insight that I think is the thing we need to keep in mind most when we think how to fix this. The financial crisis is a run. Ours wasn't a run in banks, it was a run in the shadow banking system. But that's all it was. And we don't have to fix absolutely everything under the sun. We don't have to make sure that nobody ever loses money anymore. We don't have to make sure that no institution ever fails. We need to do the little things to the financial contracts that will stop us from having runs. And that's the important part of financial crises that I think we need to really face.
The world's biggest banks are routinely called too big to fail. So should they be broken up? Yes, says Luigi Zingales. In the US, the 2010 Dodd-Frank Act, the most comprehensive rewriting of US financial regulation since the Great Depression, contained the so-called Volcker Rule, which limits commercial banks from proprietary trading. Zingales wants to go much further, reinstating the 1933 Glass-Steagall Act, the law that, until its repeal in 1999, separated commercial banking from riskier investment banking.
So originally, when there was a debate about the repeal of Glass-Steagall, I thought was a good idea to repeal it because I didn't see any compelling reason to put a restriction in the marketplace. Over the years, I changed my mind for a number of reasons. Paradoxically, none has to do with the financial crisis itself, because I don't think that the existence of Glass-Steagall would have prevented the financial crisis. However, I think is in general a good idea to separate sort of risk-taking from insured deposit, and I don't think that the Volcker rule is implementable. So if you really want something that is implementable, the Glass-Steagall makes much more sense. Second, because I think it is important to have some conflict of interest among banks, because they're so powerful in Washington that only a fragmentation of interest might keep them at bay. And last but not least, I think it is important to keep somewhat separate the banking market from the capital market, because when you have a crisis in one, the contagion doesn't spread to the other. And so we saw in the past, in 1987, where the stock market crashed with zero impact on the banking sector. Why? Because the two were very separate. And today, the impact was transmitted very fast and making it more difficult for the system to be resilient.
Randall Krosner takes a different view.
There could be a number of unintended consequences of breaking up the big banks. Risk doesn't disappear. It simply is moved elsewhere in the system, and we know the system has a lot of interconnections in it. So even if the banks aren't undertaking a particular activity, if those who are funding the banks or those who the banks are funding undertake this activity, and that's correlated with other risks that are going on in the system, the banks are just as risky. The system is just as risky. And so we really haven't addressed the fundamental issues. We have to try to make the system more robust so when risks are taken and things don't work out, the system doesn't collapse.
If breaking up the banks is one response to too big to fail, another is raising capital requirements, forcing banks to fund themselves by selling more stock or retaining more earnings. Raising capital requirements is an increasingly mainstream idea, one John Cochrane says is widely misunderstood.
Let's agree that 90% of what you read in the papers is utter hogwash. So, for example, capital requirements is not liquidity. It's not money set aside in case of danger. Capital requirements is about where do banks get the money that they lend. So let's just agree on that, and we've made tremendous progress. I think capital requirements should be much higher because I think banks should not fund their risky investments by run-prone assets. They should be selling things that look a lot like stock, where if the bank loses money, then you lose money. When you lose money in your stocks, you go home, you kick the dog, you have a scotch, but there's no run that you can go run. There's no financial crisis. Internet companies in the 1990s lost a huge amount of money, and we didn't have a crisis. Why? Because there were run-prone assets. There weren't deposits. There wasn't deposit insurance. There wasn't too big to fail. There wasn't bailouts. There was just equity-funded investments. The equity falls in value. People bear risk commensurate with the rewards they were getting, and it goes on. That's the way the financial system should work. No safety. People bear risk to get rewards. No run. We don't all think we can go in and get it out right away. And therefore, a healthy financial system.
For John Cochrane, that argument would justify equity ratios of 50 or even 100%, whatever it takes to make banks no longer think of debt as their primary source of financing and to change their basic business model. His colleague, Anil Kashyap, agrees that capital requirements should be higher, but thinks that hiking them too far would simply push business into the shadow banking sector, the less regulated world of off-balance sheet financing and non-bank financial intermediaries.
The fragility of the financial institutions is almost inevitable. I mean, that is their role in the economy, so you wouldn't want to eliminate it completely. A lot of the risks that materialized in this crisis didn't come in traditional banks. It came from other parts of the financial system or other institutions that were doing maturity transformation, and just because you stomp down on the banks, I don't think you'd fix all of it. That doesn't mean that the banks can't be better supervised, but I think it's naive, frankly, to just say if we just shrink the size of the banks, we won't have financial crises. Hiking capital requirements is another, in my view, pretty simplistic policy recommendation. Right now, there's all kinds of institutions that provide near banking services, and they do so when the banks only have to hold 10% capital. If you made the banks hold 30, 40, 50% capital, we would have a much safer banking system, and we'd also have a banking system that would be much more relevant for the functioning of the economy. So a lot of activity would move into the shadows, and we'd have instability coming from places that we weren't paying as close attention to.
Beyond breaking up the banks and hiking capital requirements, strengthening the global financial system necessitates better regulation. But in spite of new oversight rules, many Booth faculty remain unconvinced that regulation has improved significantly.
I think some people have said they've waved the magic wand of Dodd-Frank and said all is better now. Far from that. There's still many issues outstanding, even within Dodd-Frank. So a lot of my proposals involve a much more engaged role for regulators, rather than just sort of sitting on the sidelines and trying to enforce a particular law. They're really engaged in trying to look at the risks. And I worry that what a lot of Dodd-Frank has done is set up these lines that gives very strong incentives to try to get around, and so the regulators and supervisors spend their time trying to focus on narrow compliance rather than the substantive risks.
Regulation is not a question of just more or less. Regulation is not something that you just pour in the cup, and if something blows up, you pour more regulation in the cup. Regulation is smart or dumb. Regulation is full of unintended consequences or works well. And regulation is either based on clear, simple rules, or is let's give some benevolent aristocracy the right to tell us all what we want to do. I think the kind of regulation we need, and we do need regulation, but the kind of regulation you need is clear, simple rules of the game that guide people to do stuff with the right incentives.
Having clear, simple rules on how regulators should behave, rather than the ad hoc interventions of recent years, is an attractive idea. Luigi Zingales has co-authored a proposal for one such idea, using the market for credit default swaps, the structured, over-the-counter financial derivatives widely blamed for exacerbating the financial crisis, as an early warning system to alert regulators when large financial institutions are in trouble. The CDS market, he argues, has a track record as a leading indicator of financial stress, providing information ahead of the stock market, bond market, and credit rating agencies.
There are, I think, two ways to fix the system. One is to have an enormous amount of equity up front in the banking sector so that no matter what happens, there is enough equity. The second is to start with a more moderate quantity of equity, but to have a prompt sort of alarm that forces banks to issue more equity when this is needed. And for this alarm to be credible, must be market-based. And so in a proposal I worked out with Oliver Hart at Harvard, we figure out that by using the CDS on the bond of banks as a trigger mechanism, we can have such a system. It's a bit like a system of margin call, where instead of receiving your call from your broker, you receive your call from the CDS market.
Even if one jurisdiction were able to vastly improve regulation, banks are global, and winding down a systemically important financial institution would require international regulators to work together.
We're not really much closer to solving the fundamental problem than we were, but in terms of just tactically, we're much better off after the U.S. passed the Dodd-Frank bill, because we have, regulators who are tasked with the job of looking out for these crises, and there's a not perfect but pretty good resolution authority, which is a way to restructure banks when they get into these big troubles. So things are better, but there's a long way still to go. The biggest problem is that most of the runs on the banks were on banks that had many international divisions, and Dodd-Frank doesn't do anything about resolving such complicated financial institutions. And we need to do something like that, but I have my doubts that we'll be able to do anything like that on an international scale.
I think we're not going to ban financial crises, and there's no one thing that you can change to make them go away forever. Having resolution authority that would work across borders would be a good thing to make them less of a problem, but it wouldn't make them go away. What the regulators are trying to do instead is use changes in the capital structure of the banks to make it easier to fail an institution. So for instance, if you have a lot of debt that converts to equity, well, then you buy time to try to arrange a sale, because instead of selling a gone concern, you can try and sell a going concern. So I think these proposals around bailing in debt are not a perfect substitute, but they're a lot better than what we had in the last go-round. There are parts of the financial system that are now safer, but there are other parts that are just as vulnerable. I mean, the money funds are a great example. There's been 5 years of huffing and puffing and talking about doing something, and yet it's largely in the same position as it was. And there are other examples too. We don't really know if the resolution part of Dodd-Frank is going to work very well. We still haven't done very much about shadow banking, even just in the U.S. So I think we shouldn't delude ourselves into thinking that we've got an all clear.
Whether the policy response involves breaking up the banks, raising capital requirements, improving regulation, or having a global resolution authority, it seems clear that 5 years after Lehman, the global financial system is far from fixed.